Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Friday, July 31st, and we are closing out one of the more turbulent weeks we have seen in a long time. Fed shock, big tech earnings swinging in opposite directions, oil pushing toward $92, and crypto sitting at a crossroads. A lot to get through, so let's get straight into it. Lizzie, Nasdaq 100 futures are up nearly 0.7% this morning, but we just came off the Dow's worst session in over a year. Is this a genuine recovery or just a dead cat bounce?
Morning, Robert. It reads more like a relief rally than a genuine recovery at this point. The market got hammered by Fed Chair Warsh's hawkish tone on Wednesday. The Dow fell 2.2%, and futures this morning are being propped up almost entirely by Microsoft's blowout quarter. The underlying pressures, elevated treasury yields, geopolitical risk, and semiconductor weakness have not gone away. And with Amazon and Apple reporting after the bell today, there is still significant binary risk sitting directly in front of us.
Speaking of Microsoft, $90 billion in revenue, Azure crossing $100 billion annually, stock up roughly 9% pre-market. Does this single-handedly change the narrative around AI spending?
It shifts the conversation meaningfully, but it does not close it, and that distinction matters for traders. Azure growing at that scale with CapEx up 70% year over year to $41 billion gives the bulls a concrete data point that AI infrastructure spending is generating real returns. Microsoft's CFO made a specific point of reassuring investors on CapEx efficiency, and the market responded accordingly. But one strong quarter from one company does not resolve the broader skepticism, especially when you look at what happened to Meta in the very same earnings cycle.
Right. Meta told a very different story, down 8 to 9% despite solid revenues. What is the market actually punishing them for?
The market is not punishing Meta for what it earned. It is punishing them for what they plan to spend. And that is an important distinction. Meta's elevated FY26 CapEx outlook spooked investors who are no longer willing to extend unlimited patience on AI return timelines, and the data backs that up. Tech companies beating EPS estimates have underperformed the S&P 500 by an average of 3.3% on their reporting day this season, which is the weakest post-earnings reaction since at least 2019, so the bar has shifted firmly from "did you grow" to "show me the returns."
Amazon and Apple both report after the bell today. Which one carries more market risk right now?
For Amazon, the focus is squarely on AWS growth and cloud margins. After what Microsoft showed with Azure, any disappointment there would hit hard and drag the broader tech tape with it. For Apple, investors want iPhone demand signals and commentary on tariff exposure, given where oil and geopolitical risk currently sit. In terms of pure market risk today, Amazon carries more weight because the entire cloud and AI infrastructure narrative either gets reinforced or questioned based on that AWS number alone.
The Philadelphia Semiconductor Index is down over 14% in 5 sessions. Micron dropped 10% on Wednesday and was the S&P's biggest loser, and Samsung is warning the chip shortage worsens through 2028. SOXCX is 25% off its 52-week high, but still up over 54% year-to-date. Is this a dip worth buying?
It is a classic situation where the fundamental signal and the price action are pointing in very different directions. Samsung reported operating profit up over 1,800% year-on-year, driven by AI server demand, which should be a clear tailwind. But investors looked at the broader AI spending scrutiny and sold anyway. Historically, 4 out of 6 comparable SOXX drawdowns have led to strong 12-month recoveries, but buyers typically absorbed another 20% drawdown before any rebound materialized. So this is not a clean entry point by any historical measure, and that is a risk traders need to weigh carefully.
We are also seeing beats go unrewarded across consumer staples. AB InBev, P&G, Conagra, PepsiCo, and oil near $92 adds another layer. How is the geopolitical risk actually flowing through the broader market right now?
On consumer staples, the signal is straightforward. Pricing power is eroding, and the market is pricing that in, regardless of headline beats. AB InBev's beer volumes were up just 1.1%, which is acceptable, but not the kind of growth that justifies stretched valuations in a higher-for-longer rate environment. On the geopolitical side, oil at these levels functions as a hidden tax on everything. It feeds directly into PCE inflation, complicates the Fed's path, and pressures long-duration assets across the board. The 30-year Treasury yield, hitting a multi-decade high near 5.24%, is partly a geopolitical risk premium story, and that yield level is tightening financial conditions independently of anything the Fed officially decides to do.
Steve, it is a massive day-to-day. Q2 GDP, June PCE, and weekly jobless claims all hitting this morning. Which of those 3 should traders be watching most closely, given where we are with the Fed?
Robert, without question, PCE is the one that matters most in the current environment because it feeds directly into the Fed's next decision, and we just had a divided 9-3 vote with 3 members actively pushing for a hike. The Q2 GDP advance estimate is also significant. It will tell us whether the economy held up through the rate pressure of the first half of 2026, and a soft number would complicate the hawkish case considerably. Jobless claims round out the picture and provide important labor market context, but PCE is the release that moves the needle on Fed expectations most immediately and with the most force today.
On jobless claims specifically, last week came in at 187,000, absolutely crushing the 212,000 forecast. This week's estimate is 200,000. Does a labor market this tight make it harder for the Fed to justify staying on hold?
It does, and that is precisely the tension the Fed is navigating right now. A reading of 187,000 against a 212,000 forecast is a very significant beat. It tells you the labor market is not cracking under rate pressure, which removes one of the key arguments for holding or easing. This week's forecast of 200,000 is still historically tight, and if the actual print comes in near or below that level again, it reinforces the case that the 3 FOMC members who voted for a hike had legitimate grounds, and it raises the probability of further action at the September meeting.
And what does today's PCE print need to show to either validate or challenge Warsh's hawkish stance?
If core PCE comes in above the prior month's reading or surprises to the upside, it hands Warsh exactly the justification he needs for a more aggressive posture going into September, and the market would likely reprice rate hike odds sharply higher, hitting equities and crypto simultaneously. A softer print gives the hold camp real ammunition and could fuel a more durable relief rally beyond what we are seeing in futures this morning. Worth noting that the Consumer Confidence Index is also due today, with the forecast at 54 against a prior reading of 49.5. An improving confidence number alongside a cool PCE print would be the most constructive combination the bulls could hope for heading into the weekend.
Lizzie, over to crypto. Bitcoin is hovering around $64,500. The Clarity Act is stalled at 38% passage odds, and BTC has averaged an 11% drop in the 7 days after 8 of the last 9 FOMC meetings. Did yesterday's Fed decision follow that pattern?
It largely did. Bitcoin dropped to around $63,400 in the immediate aftermath of the Fed decision, with over $630 million in leveraged positions, liquidated in 24 hours, and the majority of those losses sitting on the long side. The sell the news dynamic has been remarkably consistent, regardless of whether the Fed cut, held, or hiked, and that pattern held again this week. From here, the key levels are $63,000 as near-term support, and $68,000 as the upside target analysts are associating with a Clarity Act Senate passage. But at 38% odds, that catalyst is far from guaranteed before the August recess begins.
Morgan Stanley just launched spot Ethereum and Solana ETFs alongside its Bitcoin trust that has already pulled in $400 million, pricing all three at just 14 basis points. What does it mean when a firm with that kind of distribution reach goes this deep into the space?
It is a notable development because Morgan Stanley's competitive edge here is not just the fee. It is the distribution through its wealth advisor network and the E-Trade platform, which gives it direct access to a retail and high net worth client base that BlackRock and Fidelity do not reach in quite the same way. Ethereum is down roughly 36% year to date, and Solana is off about 41%, so the entry point for new investors is not painless. But the fact that institutional infrastructure is being built this aggressively during a drawdown tells you something meaningful about long-term conviction in the space. With Tom Lee flagging $2,000 and $2,500 as Ethereum's next key targets, and the Morgan Stanley launch adding structural demand at a moment when sentiment remains cautious, this is a development worth tracking closely as we move into the second half of 2026.
That wraps up today's Morning Bell. Thank you to Lizzie and Steve for a thorough breakdown of a genuinely complex morning. This is not investment advice. Do your own research. And don't forget to subscribe so you never miss a morning. Have a great weekend, everyone.